For years, a rigid boundary existed between the heavily regulated perimeter of European banking and the decentralized frontier of digital assets. That boundary is officially gone. The Markets in Crypto Assets Regulation, or MiCA, establishes a comprehensive legal framework across the European Union, dissolving the regulatory gray zones that kept institutions on the sidelines. MiCA integrates token issuance, transfers, and key management into the core regulatory framework, treating them with the same institutional weight as traditional bank products. Consequently, banking executives must integrate digital assets into their core institutional risk and control architectures. These services are subject to the same oversight as any traditional banking operation. MiCA does offer existing EU credit institutions a structural advantage. Rather than applying for a full crypto asset service provider authorization from scratch, banks can use a streamlined notification route to enter the market. However, this creates a dangerous false comfort. A traditional CRD banking license provides regulatory standing, but it does not automatically equip an institution to manage the unique mechanical risks of distributed ledgers. Traditional risk models are built for intermediated settlement and central counterparties. They fail when applied to irreversible blockchain transfers, sudden stablecoin redemption runs, or anti-money laundering checks on unhosted cryptographic wallets. The notification route provides an entry point, but the institution remains subject to every MiCA requirement regarding conduct, custody, and disclosure. Launching a digital asset service by relying solely on a legacy banking license without building and proving crypto-specific operational controls invites immediate supervisory intervention. Before a bank can build those controls, it must determine exactly what rules apply. MiCA enforces a strict substance over form classification regime, where marketing labels like stablecoin or utility token carry no legal weight. The first step is evaluating whether the digital asset is already covered by existing traditional frameworks, like MiFID II or standard deposit regulations. If a token behaves economically like a financial instrument or a structured deposit, it is governed by those established securities and banking laws, bypassing MiCA's core crypto framework entirely. Once an asset clears standard exclusions, it enters one of three MiCA buckets. First, e-money tokens, pegging exclusively to a single fiat currency. Second, asset reference tokens, referencing a basket of assets like commodities or mixed currencies. Once the token is classified, the final variable is the bank's precise operational role, whether it is issuing the token, acting as the custodian, or operating the trading venue. A single error at this initial gateway will apply the wrong legal framework, misalign the operational controls, and contaminate the institution's downstream compliance architecture. For many banks, that compliance architecture will be tested most severely in digital asset custody, arguably the highest risk service a provider can undertake under MiCA. Safekeeping now focuses on the absolute control of private cryptographic keys, a requirement that supersedes the simple account balancing of the legacy system. Traditional securities custody relies on a chain of intermediaries and central securities depositories where errors can be reversed. Bearer asset cryptography offers no such safety net. If a private key is compromised, lost, or misused by an insider, the resulting blockchain transfer achieves immediate, irreversible settlement finality. The asset is simply gone. To mitigate this, regulators expect exact operational proofs. Banks must document key generation ceremonies, verify cold storage protocols, and deploy multi-party computation. Legally, the institution must establish strict insolvency ring fencing, ensuring that client crypto assets are segregated and shielded from the claims of the bank's own creditors. If a bank outsources wallet infrastructure to a third-party vendor, MiCA explicitly states that accountability does not transfer. The bank is required to maintain intense supervisory oversight of that vendor. Under these rules, managing private keys acts as a regulated client asset protection mandate rather than a back-end IT function. That level of scrutiny intensifies significantly when a bank shifts from custodying assets to issuing its own stable value tokens. Because e-money tokens and asset reference tokens are designed to serve as reliable payment rails, they inherently introduce the risk of sudden bank run dynamics and broader payment system contagion. If a bank issues an e-money token, the holder gains a fundamental legal right to a direct claim against the issuer, guaranteeing redemption at exact par value. Operationally, this means the bank's treasury must maintain immediate, highly liquid fiat reserves to honor continuous, potentially massive redemption requests without delay. For asset reference tokens, issuers must hold segregated reserve assets, shown on the right, that perfectly match outstanding token liabilities on the left. During mass redemption stress tests, reserves must liquidate at the exact same pace as dropping liabilities, maintaining the structural peg. If an asset reference token reaches a scale where it poses risks to monetary policy transmission or broader financial stability, MiCA demands direct intervention from central authorities. Banks must successfully model these stress scenarios and prove their liquidity resilience to supervisors long before a single token is authorized for issuance. The launch of a stablecoin acts as a systemic balance sheet operation, requiring deep integration with treasury and liquidity functions that go beyond smart contract deployment. Ultimately, navigating MiCA comes down to the standard of supervisory evidence. High-level executive summaries, theoretical policy manuals, and optimistic vendor promises will not survive a competent regulatory audit. Supervisors will demand granular operational proof. They expect on-chain reconciliation reports, finalized legal memos, and documented incident response drills. Delivering this evidence requires a strict governance mandate. Crypto asset risks must be fully integrated into the institution's existing 3 lines of defense model, involving risk, compliance, and internal audit directly. Digital asset strategies require the active, informed oversight of the board of directors. They can no longer be quarantined in experimental innovation labs. MiCA provides the legal certainty banks need to enter the digital asset space, but capitalizing on that opportunity is entirely dependent on building the rigorous, testable evidentiary architecture required to prove compliance on a daily basis.